The reality is, the majority of property developers do not do it full time.
When you hear people use the term property developer, what do they usually picture?
I suspect that almost everyone thinks of a full-time property developer going around in a Rolls Royce building large-scale developments, but that's just not the case. So for me, property development is...
Why do you buy sites that most developers avoid?
Everyone has a different risk profile. So my risk profile is I only buy deals that are deals of a lifetime.
If you had $500,000 today and wanted to become a property developer, exactly what would your first 12 months look like from now?
Hi, I'm Andrew Wright, Principal of Professional Southport, and this is the Andrew Wright Property Podcast. I've built a multi-million-dollar property portfolio, delivering a seven-figure annual rental income, and led my real estate team through thousands of sale and lease transactions. In each episode, I share real deals and strategies that will help you find, fund, and operate profitable property deals. The aim of this show is to provide education and build a community of like-minded investors who can collaborate, share insights, and help each other in each other's journeys. You can make excuses or you can make money, but you can't do both. So come and join us.
Hello and welcome back to the Andrew Wright Property Podcast. My name's Adam Bell, and in today's episode, we're going to talk about something probably everyone's thought about once or twice in their lifetime, and that's becoming a property developer. We all know the money that can be made, that we've seen property developers make. So today, rather than talking about textbook theory, Andrew's going to walk you through 3 real development projects currently going through their approval process, how he got into them, what he's doing with them, and giving you a leg up into how to think about becoming a property developer yourself. We're going to discuss what developers actually do, how to minimize the risk, mistakes he's already made so that you don't have to, why he deliberately buys unusual sites, and why he believes holding developments long-term is one of the fastest ways to build wealth. Andrew, welcome to the podcast.
How you going, Adam?
I'm well, thanks, mate. Very well. All right, so let's get started. I mean, everyone has at one point or another thought, well, property development is probably the thing that comes to mind, being a property developer, when someone thinks about making lots of money. And we think about those ones who buy a plot of land, put up, a big set of units or a high rise, but there's far more to it than that, and there's a lot of ways to get started doing it very differently to what your common person would think: buy a block of land, build high rise. I haven't got the money to do that.
Yeah, you're right, Adam, and that's one of the reasons why I was a little bit shy coming up with this topic today, because we needed to come up with a podcast because it's Sunday and we need to release one every Tuesday, and I feel a little bit unqualified in comparison to the guests we've had on this program, literally full-time developers that are doing hundreds of millions of dollars of projects. But the reality is the majority of property developers do not do it full-time, and it's almost impossible to straight off the bat become a full-time property developer because it takes 2 or 3 years before you get any returns. And for that reason, most people take about probably 5 years before they decide whether they want to be full-time as a developer or not. So we all start off part-time.
Yep, absolutely. So when you hear people use the term property developer, what do they usually picture?
Well, I can't talk for everyone else what they usually picture, but I suspect that almost everyone thinks of a full-time property developer going around in a Rolls Royce building large-scale developments, but that's just not the case. So for me, property development is any form of work that you can do to force value on a property or improve it. And it could be as simple as a renovate and flip, or the burst strategy that I've referred to in a couple of podcasts, where you just do a renovation, re-rent it out, increase the value of it, borrow against it, and then go and buy another investment. So small scale development can actually start just with renovations.
Absolutely. So a property developer is anything, from a flipper right through to that.
Right through to the high rises.
Yeah.
Yeah.
So let's talk about, what does a property developer actually do? Let's talk about a full-time one for stars, the ones we picture. What are they doing day to day?
Well, the same thing that a part-time guy does for 10 hours a week, they're doing 40 or 50 hours a week, but probably it depends on what niche they've picked. So that's the beauty about property. There are so many different niches. So someone who focuses on land subdivisions, when they get their approvals and they've got the site and they're adding value to it, their day-to-day task is going to be very different to perhaps John Facer that we had on this podcast, where he's building 40-story high-rises. So what they actually do on a daily basis is very different. What I want to focus on in today's podcast, I don't have a building team of workers employed by me. So there are two types of developers. One that employ all the builders to actually do all the ground-up construction. And the second one is small-time guys like me. I just outsource everything. So I'm probably not the most qualified person to talk about project management, and perhaps we'll get some more experienced people in to run through exactly the answers to that question. What's actually involved with project management when you're doing a full ground-up construction, because I've always outsourced it all because I don't employ any builders and I don't have any building qualifications, and I have no intention of going down that track.
Now, I know you like to talk yourself down a lot, which I find funny because, one of my questions here you've already answered is, can you become a full-time developer immediately? However, I want to make the point to our listeners that you've made and now have a portfolio and have done incredibly well through not your normal property develop. What's considered mainstream property development. You've done incredible, and you've done it all part-time. So I think you are qualified to talk about, just not in the sense that you believe is the mainstream way of doing it. Can I restructure that question? Say, do you ever want to become a full-time property developer and doing what you did say, having a team and doing that, rather than finding your niche projects, doing your research, and following the system and the strategy that you've talked about in just about every one of your podcasts that you've done so far?
Well, up to now, I've been a bit of a hybrid investor. I'm mainly an investor. I run a full-time real estate agency with doing sales and property management. So my property development has been limited to very, very part-time allocation of my resources. What I will say is that if done correctly, property development can be a lot more rewarding than working in a business where you're getting paid on an hourly rate to make a commission. And I can also say that I find a lot more satisfaction from the results of property development. Actually, going back and looking at what you've actually built out of nothing to create something for the community that you can see, touch and feel, and there's a lot more satisfaction in that. So the answer is, I hope I do become full-time one day because I find it a lot more satisfying.
Yep, you got a lot of passion, and I love, and we, as we develop this series even further, we're going to look back at projects that you've spoken about, what you've started, but in what you're saying now, you get that satisfaction from having. Seeing a deal, constructing it in your mind, constructing the strategy, and then over time seeing that pay dividends and actually come to fruition with what you've planned.
Yeah, 100%. And especially for me, because most developers have a business model where they build stuff and sell it. They pay the tax, and then next year they're out there looking for the next deal. My strategy is a little bit different. It's not for everyone. I'm not saying it's the right way to go, but I generally develop stuff, keep it for myself, because I don't want to get paid. If I'm going to put in a heap of work to do something, I don't want to get paid once. I want to get paid every year going forward. And by doing that and keeping it and reborrowing against the equity I've got there, you can build more assets in a portfolio, and that they just keep compounding, going up and up. And every really successful developer I know, even when I ask them, do you wish you had kept more of that stuff yourself? They all say yes.
Yep. Do you measure your growth per year in your portfolio value? Do you look at it each year? Do you go at we've just passed 30 June. Do you at 30 June go, right, last year my portfolio was worth XYZ million and it's now XYZ million plus ABC?
Probably monthly, I would say, but not on I don't go and get valuations on all sides, but the reason I do that is not an ego thing to track it. It's actually to look at my future borrowing capacity.
Yeah.
So when I have a little spreadsheet and I've got all these different properties here, I look at the value, I put another amount in the liability for the loan, and then I have another section, what's the LVR, because I need to keep track of that so that I can have a look at what asset I can refinance next.
Sure.
Pay for a bank valuation, get a lease stock loan and redraw some more money to have cash in the kitty to go out and do the next thing. So I'm sort of forced to review it monthly because last year I bought 7 properties. I've bought a couple already this year. And when you're doing that, it's too hard to save the cash deposit. So you have to look at your portfolio, keep revaluing it. Where can I draw the equity to go and generate some cash to come up for a deposit for the next deal?
Sure.
It's not an ego thing.
I
have to do it.
I understand
Yeah.
that. Now, can I challenge you to put this out on record, being that it is 30 June or very close to right now? Each year that we hit this point, can I ask you what your gross property portfolio is worth and essentially what the net is?
Yeah, you can, sure.
Okay, what is it right now? Because I've got to ask you again in 12 months.
The gross portfolio is about 27 million and my debt is probably about 11. So probably, 16 million net.
Okay, put that on notice. Put that on notice because we may even do it 6 monthly, because I do want to show our viewers and our listeners how that compounds.
Sure.
And realise to a lot. I mean, you ask Andrew, he's gonna tell you that those numbers are small compared to a lot of people he knocks around with. But I can tell you to a lot of our listeners, those numbers are going to be absolutely massive. But the point being is that they're all relative. They're all relative to where you are, and you started a long, long time ago. But it's the compounding nature of what you do that gets it to that level.
Well, I argue I haven't started that long ago because I lost everything in the GFC and then I got separated from my wife.
True.
And I really started about 8 years ago, Adam.
Yep. So there you go. You use the principles you learn here, but we will. I'll ask you every Christmas. I'll ask you every New Year,
Okay.
and we'll because I do. It does compound, and that's with you buying and putting more in, but it's understanding that net value, because as you've said, you want 100 million worth of debt. You've said it a few times.
Yeah.
Because we know that what that means in net terms. All right. So, what's a realistic pathway to becoming a property developer who wants to start at the start and end up full time?
Well, for me, it was I did a $500,000 renovation on my house with some extensions, learning the skill set around adding value to the property, liaising with contractors. I did the same with my own office. I did a $500,000 fit out. I had an empty shell and I learnt the process dealing with architects and doing fit outs there. And I think that sounds like a very basic thing that almost everyone listening has probably done themselves. But in a nutshell, I think that's a pretty good starting point because you should start small and work your way up.
Get that experience, get that confidence.
Yep.
As we know, it's taking that first step, isn't it? And getting actually doing it. And I want to come back to something you said a few weeks back, and that is make an offer every month.
Oh, yeah, you've got to get started. But before you do that, you probably should, we've talked about buying commercial properties, the same for development. You probably want to define your niche or your strategy.
Yep.
Are you going to subdivide land? Are you going to build a duplex, build some townhouses? What are you actually going to do? And you need to define that and what your borrowing capacity is to get started. So there's step one.
Sure. So I think you've sort of mentioned before too that probably a good idea is to start in one council area. Why is that the case?
Well, this is advice that most mentors would provide property developers. There's over 500 councils in Australia, and I'm finding out myself that every council has different rules for development, And even things like infrastructure charges can vary
Vary.
massively.
Yep.
So I think by knowing one council very well, if you know your numbers very, very well, you can assess a deal that's on the market and know your numbers pretty well and have the confidence to go and pull the trigger and buy something pretty quickly. And now that applies especially more so for builders that are developers that might have 20 or 40 people on their staff, and they need to keep buying deals to keep them busy. Someone who's got 40, remember Paul Yunan came in here a little while ago?
do.
And he's got like 40 people on his payroll or whatever it is. Now, he needs to keep buying other sites on the Gold Coast to keep those
People employed.
I don't need to do that. So the advantage to him is he can keep his costs down because he employs those people and there's no extra builder's margin in all of the costs. The advantage to me as a small guy is I don't have to go and buy another site tomorrow because I've got 40 builders that need some work.
No.
I can pick my mark. I can go out of town because I don't have 40 people that need to work here. And I can look at different councils, different areas, and I'm not forced to pull the trigger. And that's why I only buy deals that are deals of a lifetime.
Yeah. And I want to get into a couple of your case studies, which we have talked a little bit about before, but pull them apart a bit more. But before I do, a couple more questions for you. Why do you buy sites that most developers avoid?
Everyone has a different risk profile. So my risk profile is extremely high, and I have no interest in targeting something with a 15% return. I see some trainers on YouTube teaching people how to do a 1:2 lot land subdivision where you might make $50,000 or $100,000. To me, that is of no interest to me simply because I can earn that same money focusing my time and energy in my business, selling 4 more houses, and it will take me 2 months and I don't have to invest any money whatsoever. So why would I go and invest hundreds of thousands of dollars buying sites, 12 months of my life and all this effort, and maybe make $50,000 or $100,000? To me, it's not the best use of my time. Now, I'm not saying it wouldn't be for someone else.
Sure.
And that's where everyone's risk profile, your asset base, your ability to earn income in your current employment makes a big difference. So it may be fine for someone else getting started if you're in a job and you actually don't have the capacity to make a lot more money by working harder at your job. It may make sense to go out and do a small little land subdivision to make 50 or 100 grand, particularly if that's your education process where you're learning how to step up the deal size next time.
Sure.
And do bigger deals.
What's the minimum return you would consider before going into a project?
This is going to be different for everyone, and most lenders are looking for, and Paul Yunan and other developers we've had on this podcast have said that most lenders will be expecting a 20% return. I certainly wouldn't do anything unless I'm getting 25 to 35% return per annum. So that means if a deal takes 2 years, I want 50 to 70% return minimum. Otherwise, I won't look at it.
Yep. And as we've talked about in so many podcasts, there's so many different ways of actually making that happen.
Absolutely.
So, all right. So how have council pre-lodgement meetings helped you with due diligence?
Look, it's just so important. I mean, every time I buy a site and I go to a town planner, I say, here's a site and it's zoned X, Y, Z, and they say, well, what do you want to do with it? And a lot of the times I'll ask their advice, well, what do you think I should do with it? And you'd be actually surprised at how many town planners will come up with ideas, but they don't actually know what they would do because they're not developers. So most of the time the town planners will say, well, Andrew, what are you going to do? And when you get started, it's easy to have a belief that, oh, I'll just buy this site and the town planner will tell me what's the best use of the site, but they don't. Otherwise, they'd probably be developers themselves. So you need to come up, you need to have the vision, you need to work out what's the best use of the site. And going to a pre-lodgement meeting on several occasions for me in my short development career has given me much better advice and strategy than any town planner could have done, because I'll just run through a few examples.
Yeah.
I mean, a negative one, I had a building designers put together plans for an 11-bedroom boarding house in Ipswich. The town planner said infrastructure charges for this one facility would be 15 or 16 grand or whatever it was. And then we went and had a pre-lodgement meeting, and the young lady there said, oh, well, we're not going to charge you one lot of infrastructure charges. Under our council, we're going to charge you 11 lots because there's 11 different beds and baths. They're unrelated tenants. So we're going to sting you for 11 different lots of infrastructure charges. Now, the benefit I got out of that, well, the town planner was wrong with his advice. So I went straight to the horse's mouth. I canned that project immediately, and then I built a shed and put a gym in there, and I paid the council $0 in infrastructure charges because I wasn't changing the use of the site. That's the first example. Second example, 24 Hellerden Street 24 Railway Street in Hellerden, which we're about to get approval for 15 units now. I had a pre-lodgement meeting with them, and we had to build shops at the front because it was zoned commercial. And I asked a question to the gentleman at the council, would you allow me to build a couple of townhouses out the back? And myself and the town planner were absolutely delighted with his response that, Andrew, we don't care how much residential you build behind or above those shops.
As long as you tick this box at the front.
As long as it's only 2 levels in height, so it meets the, fits in with the surrounding buildings in the area. And from that advice from the council, he basically told me what the best strategy was. And I went back, and then all of a sudden we put in plans for a whole heap of units behind these shops, which increased the density massively and the uplift for the property accordingly. The third example, just a pre-lodgement meeting last week we had 6 people on a Zoom call. The Longreach Council had 2 staff, my town planner, myself, a traffic engineer, and my building designer. And we were talking about the fact that this site was 1.8 metres away, 1.8 kilometres away from where the council water mains finish. And at the end of that pre-lodgement meeting, I told them that I was actually going to build a service station here, but because it was going to cost me $1 million to extend that water mains, which was required for the firefighting requirements of a service station where there's petrol and fire risk, I decided to subdivide it into 7 large truck depots and industrial outdoor storage blocks of land. So it's just a 7-lot subdivision. And during that pre-lodgement meeting with the council on the Zoom call, they confirmed, well, that's no problem, Andrew. We will not require you to extend the water mains if that's going to be the use that you're proposing.
Yep.
And by the way, they have a large site across the road which will require those utilities at some stage in the future. So the council's probably going to go to all that expense to extend the water mains and the sewer there later. And they actually suggested, well, maybe at that time, Andrew, you could subdivide this into smaller lots because you're not going to have to put septic tanks on each one and water tanks, etc. You can just plug into the mains, which will allow me to double the density again when the council actually does it. So they're giving me the development strategies because that's what they want.
Yep.
And when I lodge it, they're not going to fight over it because that's what they actually see as a good use of the site.
Sure. And did they give you any idea on what their use was going to be for their land across the road?
No, they haven't.
Okay, because I guess depending on what that is and the fact that they're already flagging that it's going to need the water mains in, if that becomes it depends what it becomes on what then you can then turn your land use into across the road with water mains, whether that is a servo or whether it,
great question. And that's a very good question. I don't know the answer. I should ask them.
Yeah.
Whether they'll disclose it or not, I don't know.
I mean, I can't picture where you are and how far out of town or anything, but if it's residential, mate, you put a shop.
No, it's industrial.
It's still industrial.
It is industrial across the road.
Right, it's still industrial.
They've zoned it the same way as my site. Industrial investigation zone is the actual zoning.
Right, okay.
But they haven't defined what they're going to do with their industrial investigation zone land.
But again, knowing what it would be could potentially at that time change your highest and best use.
Absolutely.
Have I learned anything on this podcast?
I mean, you're talking the lingo.
Okie doke. All right, let's look at a couple of case studies of what you've done because we're talking about getting into property development. Talk me through Longreach.
Well, that one there, we've just talked about the pre-lodgement meeting. So that one there, I did an awesome deal to help my kids get in the property market. I went 1/3 each with my son and daughter.
Yep.
And I didn't have enough money to buy this site, and I got their money together. They put in 40 grand each, and I put in 40 grand, and we went and bought this site up in Longreach. Vendor finance. The people selling it were a young couple. They needed $80,000 very, very quickly because they were moving out of town, and they needed that 80 grand as a deposit to buy a house to live in this new city. So I offered them 80 grand at settlement, and I said, you lend me the rest of the money, vendor finance, for 2 years at 5% interest, and they agreed to it. And that is such a good deal for me. It's basically like exactly the same result as saying, okay, I'll buy this property now and we'll have a 2-year settlement.
Yep.
But I'll agree to release the 80 grand deposit up front. It's basically exactly the same as that, but giving us permission for early access to go in and get the uplift with the development approval.
Sure. And what is the plan? What?
Well, it's this lot 7-lot industrial subdivision. So it's a land subdivision into 7 large lots. They're about 5,000 to 7,000 square metres each, and there'll be 7 of them with a little road through the middle to allow access to the 7 different lots. So either truck parking or industrial outdoor storage. And again, I'm going to stage that development so that I can add sheds on each of the 7 lots at a later stage if the tenant wants to have a shed on there.
Sure. And of course, it was that one phone call to the council that changed everything.
Yeah, so my when I originally rang a town planner and said, what should I do with this site? They said, oh, well, Longreach desperately needs another service station out there. So that was my initial intention when I bought the site. But that one phone call to the council said, well, have you got $1 million to extend the water mains? I said, no. And that, that saved me wasting money getting a designer to go and plan a service station.
Sure. Let's have a quick look at Lawlers Road, your other case study here.
Yep.
Just remind us, what was that development? What was the plan?
Lawlers Road is also in Helidon, 15 minutes from Toowoomba, just at the bottom of the range there. So that site was 15,800 square metres of industrial land.
Mm-hmm.
I'm working through the final processes now of responding to information requests from the Lockyer Valley Council, mainly around problems with potential stormwater management.
Mm-hmm.
That 15,800 square metres can't all be developed because the water flows over there when there's big rains. And
because we know it's a flood-prone area of Australia, isn't it?
Yeah, so I thought we had the plans finalised when we did a podcast here a month or 2 ago, and I thought, oh, well, we're down to 7,600 square metres of hard stand now. It looks like that's, as of Friday, just gone when I opened my emails, it looks like that's coming down to 5,000 and something
now. So this is through flood mapping?
Yeah, and I can't explain why the engineers wouldn't have picked this up when we first did the plans. I don't know, but what I can say is that I made a mistake when I bought this site as well, because as a real estate agent, I have access to software called RP Data, and they have a flood mapping overlay thing where you can click flooding, and it'll show you if it floods. Now, when I bought that site, that's the first thing I did. Well, click on the thing. There's no blue on it, so I thought there was no flood. I thought I could buy this 15,800 square metres, use the whole lot. But what happened was, when the town planner makes investigations, they cross-reference my checks with the council flood maps. So I'm not sure if all councils have, I suspect they do, but that particular council had their own flood mapping.
That's different to RP Data.
Which is different to RP Data. And it said, well, half of this site does flood. And that just ruined my plans straight away. But we're now down to 5,000 and something.
Of a total of what, 15, did you say?
15,800. So the latest thing that I just got through on Friday from the engineers is a new bioretention basin where the water fills up in this particular area before it's slowly released out to the council gutters on the road. Some big culvert box things that they're going to stick under the concrete overpass to let the water go through so it doesn't build up and sort of flood. And and a bit more earthworks. So because the site is reasonably flat, most of it, I have to do a bit more earthworks so that the water actually runs in a particular direction into these bioretention basins. So the usable area of that site is going to be a lot less than I anticipated. It's still not finalised. We're still about to lodge the final paperwork to respond to the information request. But the key with all of these sites is I've made mistakes with all of them. The church one in Ipswich, I bought it to subdivide, and I worked out after I bought it that I couldn't connect the sewer because it was too low and shit doesn't go uphill. Yep. And I sold that one at a profit as well because I bought right. So you don't have to be perfect. You can make a lot of mistakes. As long as you buy well and have alternative uses for the site where you can rent it out and get some sort of cash flow to survive so that you're not making a massive mistake. Property is very forgiving, and you can make mistakes and not lose your investment. And even that church site, I mean, I flicked it within 18 months for a 200 grand profit. I did nothing to it because I bought it right.
Yep.
I knew my numbers, and it's okay to make mistakes.
So you've lost 2/3 of the use of this Lawler's Road. Is that just now unusable for anything?
Yeah, they're not even the feedback I have is from the council. We've got to promise them that there'll never be any cars or trucks going on that low land.
So there's nothing left.
No, I mean, if I got 5,500 square meters of it, I mean, I bought that site for $420,000. I thought it was, X amount per square meter. Now I've got to go back and say, well,
a third of it. It's actually basically a third of it. Yep.
It's about $80 a square meter. Now, if I can only use 5,500 and I paid $420, it's not $20 a square meter. I bought it at about $80 a square meter, but it's okay because I still bought it so cheap. Remember, Yatla is $1,500 a square meter.
That's right.
And my return on this one, even at a reduced area of 5,500 square meters, I'll still make a 50% return over 2 years, building that out, which is 25% a year.
Which is your minimum.
Which is my planned minimum, yeah. So it's still going to work out okay.
Right. Looking back at the mistakes you've made, and you've just said, property is forgiving. You can make these mistakes and still do well. Yeah. But hindsight's a wonderful thing. You've just explained the mistakes. In hindsight, was there anything you could have done where these mistakes wouldn't happen, or do you just have to accept at times, like where you've looked at the RP data, flood zones, and it's not there, but the council says they are, that this is just going to happen sometimes?
I think the answer is if you've built a team of consultants and you buy a property with a due diligence clause, you can always spend money paying consultants to provide, for example, the flooding advice. I could have got advice from the engineers or hang on the council.
During a due diligence.
Yeah, the due diligence period.
Would you have still bought it?
Yeah, I think I would have. And this is the same thing as the 24 Railway Street, Helidon. I made a mistake there not doing due diligence with my lawyer. He said, Andrew, do you want me to do any more searches? I said no. And I found out later that the state government wants to reclaim 1/4 of that land to expand the Warrego Highway. So I made another mistake on that site too. But I bought it so cheap that I'm still going to do very, very well out of it. In fact, that site there, 15 units, I bought that. I didn't even have enough money to buy that either. I got my ex-wife to put in half. We put in 60 grand each, and we bought it for $120,000. For 2,000 square metres of commercial land on the main street in the middle of the city in that town. I'm going to sell 1/4 of that land back to the state government because they're going to force me to because they want to expand the Warrego Highway. And I'll get 50 grand back from that. So the land's cost me $70,000. I'm going to build 15 units on it. So the land content of each unit is $5,000 is my cost of land for each unit. Now, if there's no margin in that,
you're doing something wrong.
I'm doing something wrong.
That's
so,
it.
It's going to work out all right,
Okay.
even though I made a mistake.
Now, all of your developments, pretty much all of yours, are staged. Why is staging developments so important, and how does it benefit you?
I think there's three main reasons. The first one is the infrastructure charges. So with these industrial outdoor storage units and truck parking depots, if I'm going to put a fence around and some hard stand and have trucks parked there, that's my stage one. Stage two is building a big shed on there if those tenants actually need a shed. Now, the benefit of putting it in stages is when I build the truck parking depot, I only have to pay the infrastructure charges for the hard stand. Now, if I didn't stage it, they would whack me for the infrastructure charges for the shed as well. But by staging it, I don't actually have to pay the infrastructure charges on building these sheds unless I decide to build the sheds. The second thing, which is very, very important, is when I go to borrow money to actually build these things, if I've only got to raise money for stage one, it's a lot more feasible for me to borrow money because the banks in most cases won't lend me all the money to build the whole thing. I can do it in little stages, borrow a little bit of money here, build stage one. When that's finished, then I have the borrowing capacity once I've leased it all out to go to stage two. Okay, and the third reason, which is really underrated, is when you get a development approval with a council, in most cases, with most councils, they will put a time limit on the approval, and it might be 4 years, for example. Now, there's so many sites in this country that have development approvals that never get built, and developers quite often will go at the end of the 4 years and pay a fee of $1,000 and say, well, council, can you extend this for another 4 years because I haven't quite got round to building this? In most cases, they'll agree to that, but in some cases, when there's a change in council or some other change in the local town plan comes up, they could just turn around and say, no, we're not going to let you extend this because we don't want it to be used for that anymore, and you've just wasted all your money. But by staging it, the majority of times in the majority of councils, you have a time limit to complete stage one, and stage two and stage three can be done any time in the next 100 years.
Yep.
So you don't have that time limit, and you're not going to lose it.
even having to go ahead with stage 2 or 3 if circumstances change.
That's right.
Yep.
Exactly. And
rather than jump in and do the whole lot at once.
Yeah, so I could go and do stage one at that 24 Railway Street, Helidon, which is 3 shops, which I'm not confident in leasing out, and 4 little one-bedroom units. I'm confident I can rent those 4 little one-bedroom units within 2 weeks.
Yep. But
it's going to be a lot harder to find people to operate a business in those 3 little shops. Now, if I never rent them out, I may never get to stage 2 because I've got to get stage 1 profitable first before I can fund the cash flows for stage 2, which is another 12 2-bedroom units.
But there is another good point to all of this, and that is the fact that you think beyond stage 1, that you actually do have a staged plan, that there is A, B, C, and D.
And you're right. And you know, the old philosophy, a journey of 1,000 miles begins with a single step. And building 15 units for me is a bit scary, but building 7, you know, I can handle that a lot easier. So a journey of 1,000 miles begins with a single step.
Perfect. Now, you mentioned early on in this podcast your whole strategy around everything you do with your property investments is develop and hold. Or
buy and hold.
Buy and hold. Let's just say and hold.
Yes.
Not to sell. Now, most developers, as you've said, buy and sell. Why don't you?
Well, I don't mean this to come out in a disrespectful way. There's a lot of developers that are a lot smarter than me and have made a lot more money developing stuff, selling it, and moving on to bigger and higher development, bigger scale developments. But my feeling is if you're doing that, development is just a job. Every time you sell, you're paying tax, and next year you're unemployed, you've got to go out and find another site. My feeling is if you can build to rent it out instead of selling, you're increasing your asset base and compounding the number of assets you hold, which every 10 years should double in value if the last 50 years has been a good example in this country. So why not keep each investment, and then at the end of 10 projects, you've got 10 sites there that will hopefully all double in value in the next 10 years, and you haven't paid tax once on crystallising an asset because you haven't sold anything. So to me...
So to answer that question that I've just asked, I'm going to answer it in one word for you. You've just explained it. That's tax.
tax and compounding, having a bigger asset base
Yep.
to compound. Because if you sell everything and then you're starting every year at scratch thinking, what am I going to do this year to make money? You're literally, it's just a job. Whereas if you can get more and more assets compounding, one, you've avoided the tax, but two, you've got a lot bigger asset base. I mean, even now, we talked about that $27 million in property. Now, I'm only just getting started. But if that just goes up 10% a year, that's 2.7 million before I get out of bed. Now, most developers might be happy to make 2.7 million in 1 year doing I get that before I get out of bed because I've got those assets compounding.
Absolutely, and not paying tax. All right, what's on the horizon, Andrew? What's next? What's coming up?
I have recently had discussions with another town planner about a couple of the blocks I own in Ipswich. One of them, 3 to 5 West Street, Ipswich, had prior development approval for 170 units, a 15-storey building. And
this is a car park at the moment.
This is a car park.
If I remember correctly.
It's just rented out to the Ipswich City Council as a car park. And one of the other blocks in that whole group that I bought there, number 13 Ellenborough Street, had approval for a 5-storey commercial building. And I'm just thinking that I might get the ball rolling in getting new approvals because those approvals lapsed. And I'm thinking that it might be time to add some value to those sites just in case the council stop paying me rent on the car park because they've been there 21 years, but they've never signed another lease since they started. It's just 1 year at a time. They could just stop paying me rent tomorrow. And if they decide to do that, I don't want to then spend 2 years trying to get a development approval for that car park. I want to have something
in place.
I'm thinking it might be worthwhile spending money now as a risk management thing so that I've already got approval. And if the council stops paying rent, it's there ready to go.
That gives you two options then, doesn't it? And yours is hold and develop and hold or buy and hold. So you've got that one there where you could actually then start and let's call it staged. If you how many did you say
170 units in that case?
Start with 10 and move on, or you've just increased the value of that site.
And if I have to, I could just sell it.
You could just flip it.
I could just sell it.
Yeah, but you're stuck if they leave tomorrow and you can't find another tenant for 2 years trying to get the approval.
That's exactly right.
If you've either got to get a tenant or you've got to get
100% right. Yeah. And all of this sort of exit strategy thinking is important. Even though I'm buy and hold, that other site in 24 Railway Street, Hellerton, with 15 units, I'm on purpose structuring that so that I can strata title them on 15 separate titles. So if I can't afford to hold them all and I need to flick a couple to get some cash in the bank and reduce my debt, I can just sell 1, 2 or 5 of those 15 units if I'm forced to. So instead of just putting it, designing it all with one water meter, for example, where I can't subdivide them into 15 lots, I'm going to have 15 water meters, okay? And I may decide to put it on one title initially so that I only get one rates notice, and it'll probably be a lot lower than getting 15 rates notices. But I've structured it so that there will be 15 meters. I just haven't connected them all. And if I need to down the track, I can strata title them into 15 different lots and I can just go and sell 3 or 5 if I need to raise some money. And that'll probably increase the valuation of them too if they're actually 15 separate properties.
For sure. You've got something on the go in Emerald as well?
I bought a truck parking depot there again, which is leased to a transport company, a mum and dad truck parking company. They have their semi-trailers there, etc. Now, they're on a 2-year lease there, and same situation. If they decide to move out, I've got plans there already approved to build a 900 square metre shed on that site. So I didn't get that approval. Actually, I inherited it when I purchased it. And just before I settled, I made it a condition of the due diligence clause that I will continue with this purchase if the seller goes to the council in the next month before it expires and actually extends that development approval for another 4 years. So he paid the $1,000 fee, gave me another 4 years to build the shed if I need to. And if my tenants there decide to move out, same thing. I've got and he paid all the infrastructure charges up front too, by the way, so I can just go and build that shed if I need to. Now, I'm not planning to do it, but it's in the future. If that property becomes vacant,
risk management.
I'll do it.
Risk management.
Yep.
Andrew, I want to finish off with one question. If you had $500,000 today and wanted to become a property developer, exactly what would your first 12 months look like from now?
Look, my right now at this point in time, my passion is truck parking depots simply because I'm of the most important philosophy of real estate to me is that land seems to value every 10 years, double in value every 10 years. So industrial land is large chunks of land, and truck parking has no buildings depreciating on it. There's no leaking roofs. There's no air conditioners going broke. There's no tenants. Yesterday I had a tenant, Andrew, I've locked myself out. Can I come and collect your spare set of keys? You don't get that sort of stuff with an empty chunk of industrial land. So for me, my passion definitely is industrial land, and I'd be going down that track. But that changes over time. So I don't actually like your question because 6 years ago, I finished building my first boarding house, 8 bedrooms, 8 bathrooms, and it was such a great cash flow. I said, well, forget about all these other strategies. Why don't I just go out and build a whole heap of boarding houses? But the problem is on the Gold Coast, they only let you build up to 4 rooms without development approval.
Yeah.
And it doesn't make sense with a 4-bedroom boarding house. And I haven't found any other great sites in Southport where I can build 8 to 10 bedroom boarding houses. So I haven't been able to do that strategy, but I thought that's what I would do going forward. I'm just going to go and build a whole heap of boarding houses.
You might not like that question, but I do, because I'm going to give you an alternative answer. I'm going to look straight down the camera when I do. If you've got 500,000 and wanted to become a property developer right now, what I'd do over the next 12 months, I'd be actually going to your computer right now and writing in hello at Andrew Wright property.com.au and writing Andrew an email and telling him you've got 500 grand, you want to become a property developer. You do not know what is going to happen out of that conversation. And that's what this is actually all about, this entire property podcast. He's not here to sell you a course. He's not here to do anything other than create a community of like-minded property investors who want to do well, who want to learn off each other and who want to make money and collaborate. And, he's open to JVs, but he's open to just giving advice as well. If you've got 500,000 want to become a property developer, send Andrew an email. That's the answer.
You've turned that into a great question. But the other reason I didn't like the question is who cares what I would do with it? Every person listening will have a different strategy. Now, if they're a builder, they might want to build their own duplex. They might want to build 5 townhouses. They might just want to do a land subdivision. So don't worry about what I would do. Find your little niche. I can point you in the right direction, no matter what that is, with the right mentor for you, because I know a lot of smart people, a lot smarter than me, that have done each of these strategies. And if I can't help you, I'll introduce you to someone who can.
I can hear your phone pinging. The emails are coming in. The listeners of listens know. So look, Andrew, another great episode. There's so many great takeaways. But look, I am serious. This is what this podcast has been created for. If you're in the property development game, if you want to be in the property development game, if you want to be a guest on the podcast, if you want to do anything, give Andrew an email. He's there. He answers every email and wants to chat to like-minded individuals. If you've enjoyed this podcast, please share it with anyone else interested in property. It's you that helps us get this podcast growing and out to people who get value from it. So hit that subscribe button. Don't miss any. Jump back. There's 30-odd episodes there with some incredible strategies and education stories, real wins, real losses. That's what this podcast is all about. So, Andrew, thanks once again for joining me. I know you've got a cracking lineup of guests coming up in the next 5 or 10 episodes. So, look forward to that. But I also look forward to being in the hot seat with you again very soon.
Thanks, Adam. Can I just do a little bit of rebuttal? I said I was very shy to do this podcast because I don't feel overly qualified. I am only a part-time developer. But the other flip side to that is, hopefully people listening can relate, because there's so much about property development that I don't know. But the key is you don't need to know, because the town planner has been doing it for 20 years. The engineers have been doing it all their life. You don't need to know it all.
You just need to know the people who do know.
You need to know who you can bring into your team to sort it out, but you do need to buy the site well. That's what you need to really focus on and have a good idea of where you can add value.
Absolutely. Andrew, thanks once again.
Thanks, Adam. Thanks for listening to the Andrew Wright Property Podcast. This is all about building a community of like-minded investors who can share real-life stories, experiences, and collaborate with a view to helping each other. Join us. Get in touch through the link in the show notes. I look forward to you joining me on the next episode.